This is Optimal Finance Daily, episode 2010, Beating the Market, 4 Ways to Outperform Index Funds, Part 2, by Stephen Keyes of tripofolifestyle.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now, today's post is a continuation from yesterday. So if you're new here, I'd recommend listening to yesterday's episode first. But if you're all caught up, let's hear part 2 and continue optimizing your life. Beating the Market, 4 Ways to Outperform Index Funds, Part 2, by Stephen Keyes of tripofolifestyle.com. Lots of relatively inefficient markets still exist in the world, spanning everything from local real estate to rare trading cards to used furniture. As a general rule, the fewer financially minded eyeballs that are on a marketplace, the more opportunity there is to make favorable trades there. But there are some limitations and disadvantages to this strategy too. For one thing, you need to know a lot about a market to really have an edge there. Your goal is to snag mispriced items, so you need to be really good at correctly pricing those things without the help of data from thousands of other bidders and sellers. And by trading in markets with only a small number of participants, you're exposing yourself to liquidity risk. You might not be able to find buyers for the stuff you're eventually going to try to sell, at least not without some serious patience. It's not as easy as just clicking the sell button on a brokerage website. Number 3, making use of government programs. Some investment opportunities exist entirely outside of the free market, making them immune to the theory of efficient markets. For example, U.S. savings bonds can't be sold by investors at all. They must be purchased and later redeemed directly with the U.S. Treasury. Because of this, their value is stable, relatively predictable, and sometimes exploitable. For example, a Series EE savings bond is guaranteed to double in value over a 20-year holding period, regardless of its interest rate. That implies a 3.5% annualized return if held to maturity. Normally, 3.5% wouldn't be very exciting. But over the past 12 months, April 2021 to April 2022, the highest guaranteed 20-year bond yield available in the open market has fluctuated between 1.7% and 3.1%. Since savings bonds can't be traded on the open market, index funds are unable to hold them. They contain ordinary treasury bonds instead. That means the very best bond market index funds have been forced to buy technically inferior 20-year treasury bonds recently, assuming they intend to hold them to maturity. An even more provocative example is the Series I savings bond, also known as I-bond, whose guaranteed yield is linked to recent inflation. Since we've seen historically high inflation lately, the yield on these bonds is set to jump up to 9.6% in May 2022. Temporarily. That's dramatically better than any other low-risk investment in the market today. In fact, Series I savings bonds bought right now in April 2022 are very likely to outperform total bond market index funds over the next 12 months. Other examples of government-manufactured opportunities that can boost your effective investment returns include tax-sheltered accounts like IRAs and HSAs, and subsidies on certain types of purchases, like electric vehicle tax credits and health insurance premium tax credits. The main drawback to government investment programs is that they're usually temporary and or very limited in scope. For example, you can only invest $10,000 per year in I-bonds through Treasury Direct, and there are annual contribution limits on tax-advantaged accounts like IRAs and HSAs too. And finally, number 4, investing in your own business. Another way of beating the market is to invest in your own business instead of the publicly traded companies found in stock index funds. Teaming your money up with some hard work allows you to build sweat equity. My 18-year-old brother is an auto mechanic. Just last year, he bought a 2007 Dodge Charger with 175,000 miles and a busted radiator for $2,000. Fixing it up cost him another $300. That $2,300 investment, plus about 8 hours of his time, led him to resell the car for $6,200 inside of 2 weeks. he definitely beat the S&P 500 with that money. In a similar vein, my dad and his wife recently bought a beach condo that needed some love. They put in work to make it look beautiful, and now they serve actively as Airbnb hosts with the hope of outperforming more passive rental properties or REIT index funds over the long run. Pouring money into your own business puts you in the driver's seat of your investment, and a lot of times you can crush the returns of the stock market by doing it yourself. But it can be a little riskier, and the most obvious drawback is that it's a lot of work. The worst ways of beating the market. We've clearly shown that outperforming index funds is possible, but it's no free lunch. If someone tells you they have a simple and effortless way to consistently beat the market without additional risk, restrictions, or effort, run away. Here are some of the worst and most popular ways of supposedly beating the market. Number 1, actively trading securities. When an inexperienced investor hits the jackpot on an individual stock, options contract, or crypto trade, it makes them feel like a genius. But it's almost impossible to consistently outperform other speculators in an efficient marketplace. If you've done well with stock picking or day trading so far, congratulations, you're in the minority. But now's a great time to take your money and leave the casino. Number 2, paying a mutual fund manager. High-fee, actively managed mutual funds really do outperform indexes like the S&P 500 occasionally, but it's impossible to tell which ones will do so in the future. Looking at past performance doesn't work because of survivorship bias, and on average, active mutual funds underperform comparable index funds by an amount roughly equal to their fees. And number 3, buying life insurance. If you need financial protection for your dependents, a term life insurance policy might make sense. But any life insurance policy that touts itself as an investment, like whole life or indexed universal life, is bad news. Most insurance companies just invest your money in the same way you could, and then they skim off some profits for themselves. Their marketing materials are often full of half-truths to make you believe otherwise. If you really want to consistently beat the market with your money, you'll need to accept more risk or put in some hard work. There's just no way around that. But it's also worth noting that you don't need to beat the market at all. In general, decreasing your expenses is more important than getting higher investment returns, and you can save enough to retire in as little as 10 years by just working a regular job and investing passively. There are definitely ways to beat the market, but personally, we'll probably keep index funding our way to a lifetime of freedom and leisure instead. It's just easier. You just listened to part 2 of the post titled Beating the Market, 4 Ways to Outperform Index Funds by Stephen Keys of tripofalifestyle.com. Of the suggestions in this article, the one I found most appealing is investing in your own business. It's certainly more risky, but I've found for myself that those risks are more manageable when you also live well below your means. Not only will you have the safety net of your savings to give you the financial bandwidth you need for your business, but you'll likely be better at bootstrapping. I took a big risk on my own business called the Economy Conference, which is basically a party about money designed for the FIRE movement. I started working on it in the summer of 2018 and held my first event in 2020, where I took a $40,000 loss, also known as a $40,000 investment. Thankfully, I didn't have to take on any debt for this loss, and I could just cash flow it out of my 60% savings rate from my W-2 employment. My second event this past November helped recoup some of my investment, and my third event is projected to set me up for long-term business sustainability. I believe when it comes to entrepreneurial risk, patience is a huge asset, and our ability to be patient is amplified when we have a high savings rate from other sources of income. I won't see a return on my investment until 5 years after I started working on Economy, but that return blows my stock portfolio out of the water. It also comes with the benefit of creating something I really want to see in the world, and to do work I find incredibly meaningful. So if you have something you want to create, start stockpiling your resources now so that you can give your dream the gift of time. And that's another episode of Optimal Finance Daily in the books. Thank you for your support and for listening every day. I'll be back in just a second with a bonus episode. So I'll see you there where your optimal life awaits.